Assalamu alaikum to everyone. Uh, Dear students, extremely important and a small lecture on capital allowances. In this very small lecture, very important as well, we are going to cover the changes in capital allowance in Finance Act 2021 only in corporation tax. In There are no changes for individuals. We have changes in capital allowance for corporation tax. So let us quickly discuss what are the changes. Maximum annual investment allowance is 1 million. The maximum annual investment allowance for 12 months accounting period is 1 million, the same as for sole trader. The AIA amount 1 million is included in the tax rate. Okay, now let's talk about enhanced capital allowances. What is this? Enhanced capital allowances. Companies purchasing new qualifying plant and machinery between 1st April 2021 and 31st March 2023 will be eligible to claim 130% super deduction for asset which would ordinarily go into the main pool, or 50% first year allowance for special rate pool assets. A very important concept and the rule. If companies purchasing new qualifying plant and machinery between 1st April 2021 and 31st March 2023, there will be, in case of main pool asset, there will be super deduction of 130%, and this super deduction will be given first. This super deduction will be given priority over investment annual investment allowance in case of main pool. So simply, let's say if there is an addition which goes to main pool between 1st April 2021 till 31st March 2023, assuming company has bought one plant costing 4 million. This qualifies for super deduction. So what do you have to do? Very simple. Super deduction. We'll take 4 million into 1.3. If you simply take 130% of 4 million or multiply 4 million with 1.3, it's the same thing. So basically, you will be getting the capital allowance of 5.2 million. So in the allowances column, we are going to write 5.2 million. So if XYZ company has bought the plant and machinery which is the asset of the main pool, then super deduction 130% is available if purchases are made within these two dates. For example, company A PLC A Limited bought 4 million plant which is of main pool asset, so we'll get super deduction 130%. 130% of 4 million is 5.2 million, which means in the allowances column, I will take 5.2 million. Now let's talk about spatial rate pool. For example, if we bought an asset, which is not a car, number one, because high emission car is also the spatial rate pool asset, but we know that high emission cars, they don't get any annual investment allowance. Let's say we bought a spatial rate pool asset, long life asset, for example, which is of a spatial rate pool. Let's say there's an addition of the asset which qualifies for spatial rate pool. An addition took place between these two dates. Assuming asset is having a value of, let's say, 3 million. In case of a spatial rate pool, in the year of addition, in the year of purchase, if asset goes to spatial rate pool, first we have to take annual investment allowance, and we know that 1 million is for 12 months accounting period. If your accounting period is other than 12 months, then this annual investment limit will be time apportioned. First, you have to deduct 1 million, and this 1 million will go to the column of allowances column. Remaining amount is 2 million. On this remaining amount of 2 million, you will be getting 50% first year allowance. On this remaining 2 million, you will be getting 50% first year allowance, which is also obviously 1 million. This 1 million also goes to the allowances column, and the remaining 1 million, let's say this is spatial rate pool, the remaining 1 million goes to spatial rate pool. Now, very important concept. In the year of purchase, in the year of addition of a spatial rate pool asset, you will be getting allowance according to this example, you will be getting allowance of 2 million, and from the next accounting period, this 1 million which is still in a spatial rate pool, on this 1 million you will be getting 6% WDA, but from the second year. So in the year of purchase of a spatial rate pool asset, first you will be getting annual investment allowance. On the remaining amount you will get 50% first year allowance. After that, whatever is left in a spatial rate pool, you will be getting 6%, but from the second year. Another very important concept is we know that annual investment allowance 1 million limit is for 12 months. If accounting period is different than 12 months, then if accounting period is different than 12 months, then it will be of course time apportion. In case of companies, we know that chargeable accounting period cannot exceed 12 months, but it might be lower. It is possible it might be lower than 12 months. So we will time apportion annual investment allowance limit, but first year allowance limit cannot be time apportion. So 50% will remain 50%. It cannot be time apportion. First year allowances cannot be time apportion. Now let's come here. The enhanced capital allowances are included in the tax rate. Okay. For expenditure on the main pool, 130% super deduction should be claimed instead of AIA. You will not be claiming AIA. You will be claiming 130% super deduction in case of addition of the main pool asset, which qualifies for obviously super deduction. However, for spatial rate pool expenditure, annual investment allowance should be claimed in preference to the 50% first year allowance, with the 50% first year allowance applied to the balance, if any, of the expenditure. The relief is not available on second-hand asset, cars, asset bought in the final accounting period of trading. We know that if it is the last year of the business, then you won't be getting these super deductions. Once a super deduction has been given to an asset, there is no balance left to transfer to the main pool. Yes. For asset given 50% first year allowance, the remaining 50% of the cost is transferred to spatial rate pool. This is then eligible for 6% from the following accounting period. A question will not be set in exam involving the disposal of an asset on which enhanced capital allowances were claimed. Accounting period straddling 31st March 2023 where enhanced capital allowances expenditure is incurred will not be examinable. And this, whatever we are discussing, it is for ATX as well as tax. Let's just check this. Super deduction. Spirit Limited has an accounting reference date 31st March. During 31st March 2022, Spirit Limited purchased fixed machinery costing 5 million, integral feature costing 1.5 million. Integral feature is the asset of a spatial rate pool. The balance brought forward in the main pool is nil. The maximum capital allowance is very simple. This fixed machinery costing 5 million goes to main pool. So it's a main pool asset, so you'll be getting super deduction of 130%, which means that main pool asset qualifies for super deduction. So super deduction. Simply 5 million. If I take 130% of this, means just multiply 5 million with 1.3, you'll be getting 6.5 million. So in the allowances column, allowances column, we will get 6.5 million allowance. Obviously, after getting super deduction of 130%, nothing is left in the balance to be transferred to the main pool. So next, integral feature of the building is basically the main pool asset. In case of main pool, is the integral features is spatial rate pool asset. In case of a spatial rate pool asset, you will be getting first. You need to claim first annual investment allowance, and on the remaining balance, you will be getting 50% first year allowance. So this is spatial rate pool asset. we have 1.5 million. So first we'll be getting annual investment allowance of 1 million. First we'll be getting annual investment allowance of 1 million. Okay. And this 1 million goes to the column of allowances column. Now I have a remaining amount 5 lakh. On this 5 lakh, I'll be getting 50% first year allowance, which is 250. So this 250 will also go to the allowances column. And remaining 250 will go to the special rate pool column. And from the next year on this 2,50,000, we'll get 6% written down allowance. So in the year of addition, Spirit Limited will get the total capital allowance 7.75 million. In the year of addition, Spirit Limited will get allowance of 7.75 million. I think I've given you the answer as well. You can see this. Look at the format of capital allowances. Total written down value brought forward, additions not qualifying for AIA. Additions, obviously we know that cars, they don't get AIA. Cars 1 till 50 gram, that's a standard emission car that goes to main pool. Over 50 grams per kilometer is a high emission car that goes to special rate pool. Qualifying for super deduction, plant and machinery acquired on after 1st April 2021. The super deduction 130% is available. What do you have to do? Take the amount of the plant into 130% and the same amount as super deduction. So obviously balance will be zero, which will be transferred. Zero will be, obviously we will be left with zero. We will left with nothing to transfer to the main pool. And this super deduction comes here as allowances. Qualifying for AIA, special rate pool expenditure pre 1st April 2021. If there are pre-expenditure in special rate pool which qualify for special rate pool, you will be only getting AIA. You will only be getting AIA because first year 50% first year allowance is only available when you have the additions of a special rate pool on or after 1st April 2021. But if you are having special rate pool expenditure pre 1st April 2021, then only annual investment allowance of 1 million is available. So here's the addition. I've deducted 1 million. The remaining goes to special rate pool. Okay. Now in the year of addition, you will be getting 6% on this amount as well, because now we are talking about expenditure relating to special rate pool, but pre 1st April 2021. So what happens previously? What used to happen? We used to take 1 million on the remaining amount. We used to take 6% written down allowance in the year of purchase as well. Main pool expenditure second hand, but pre 1st April 2021. So in case of main pool, there are, let's say, main pool expenditure, even they are second hand, but these expenditure are pre 1st April 2021. So we get only 1 million annual investment allowance. Whatever is left on remaining amount, you get 18% WDA. Now let's talk about super deduction. Special rate pool expenditure on after 1st April 2021. First, you will be getting maximum 1 million. Then whatever the balance is left on this balance, you will be getting 50% balance of the special rate pool expenditure for first year allowance. You'll be getting 50% first year allowance on this balance. Disposal will be, of course, lower off, we know that. So let us apply these rules. Short accounting period, we know that AIA limit will be prorated, but first year allowance are always given in full. They are never reduced for a short period of account. In case of companies, we know that if your period of account is more than 12 months, then you have to split into 12 annexes. In case of companies, we don't have any private use adjustment. We don't have any private use adjustment. Let us see this question, what it says. Compute capital allowances available to Build Limited for the year ended 31st March 2022 and 31st March 2023. Okay. Assuming Finance Act 2021 rule applies throughout. Build Limited prepares accounts to 31st March. The company's tax return on value on 1st April 2021 on main pool was 23,500. In 2 years ended 31st March 2023, the following capital transaction took place. Year ended 31st March 2022. First, we need to calculate capital expenditure for the year ended 31st March 2022, and after that, we'll be calculating allowances for the year ended 31st March 2023. 1st November 2021, purchase plant costing 13,260. This qualifies for super deduction 130%. 10th November 2021, sold 2 lorries, purchased 8450 each for 2,500 each, multiplied by 2, 5,000. In case of disposal, we know that we deduct lower of cost and sale proceed. Purchase 2 replacement lorries for 5250 each, multiplied by 2. And these lorries, they qualify for super deduction 130%. Only cars, they don't get any super deductions. Lorries, they do get super deduction. Then they're talking about 2003. So they're talking about 2023. So let us first solve the question for 31st March 2022. Year ended. Year ended 31st March 2022. Main pool. I have not seen any special rate pool asset. Another column is allowances. Tax written down value brought forward. For main pool, dear student, they have already given us 23,500. Additions qualifying for super deduction. Additions qualifying for super deduction. Addition qualifying for super deduction. One is plant and machinery. Plant and machinery. We'll take the purchase amount is 13,260. Simply multiply this with 130%. If I take 130% of 13,260, I'll get 17,238. Lorries, they also qualify for super deduction. And we bought 2 lorries. One is costing 5,250 multiplied by 2, then into 130%. So we are getting 13,650. So if we add 17,238 plus 13,650, it gives me 30,888. Entire 30,888 is available as super deduction, and that will go to the column of allowances. Super deduction at 130%, the entire amount comes, so balance 0. 30,888 goes in the column of allowances. In case of disposal, we know that cost or sale proceed, whichever is lower, that will be deducted. Sale proceed is lower for the lorries which we have sold. It was 2,500 each, so multiply by 2. So disposal proceeds from the main pool, I'll deduct 5,000. 23,500 minus 5,000 gives me 18,500. On this 18,500, we'll take normal written down allowance of 18%. So 18,500 into 18% gives us 3,330. This 3,330 goes to the column of allowances. From 18,500, if we deduct 3,330, we'll get 15,170. So simply we have 30,880 plus 3,330. If I add both of these figures, so the total allowances are 34,218. Total allowances. Total allowances are 34,218 and 15,170 is total written down value, but now it is carried forward. So 15,170 is carried forward. Okay. Now let's talk about next year. Year ended 31st March 2023. Total written down value brought forward 15,170. Okay. Now let's check what do we have in the question. Just a minute. Just a minute. Okay. Purchase a motor car with CO2 emission 49. So that's a standard emission car that goes to main pool, and cars they don't get any annual investment allowance. They don't get any super deduction. The car will be used by MD managing director 25% of the time for the private purposes. In case of companies, there is no private use. December 22 sold a machine for 12,000 cost. So obviously, we'll deduct this lower of amount. So we have one edition in 2023, but this edition is not qualifying for AIA. It is not qualifying for first year allowance as well. So let's come here. Edition not qualifying for AIA. It is not qualifying for AIA. It is in fact not qualifying for first year allowance, or it is not qualifying for first year allowance. It's a standard emission car, 7,500. Disposal is lower of disposal proceed and cost. So disposal proceed is 12,000. Total written down value brought forward is 15,170. We'll add 7,500 minus 12,000. We'll get 10,670. On this 10,670, we will apply written down allowance 18%. On this 10,670, we'll apply 18% written down allowance. I'll get 1921, 1921. This 1921 goes to the column of allowances. So the total allowances which we have in 2023, total allowances. Total allowances are 1921. Total written down value carried forward. Total written down value carried forward. Just a minute. What is happening? Something different. So 10,670 minus 1921, I'll get 8749. So in case of corporation tax, dear student, we know that we don't have any private use. So in this short video, dear student, I try to cover changes in capital allowances in Finance Act 2021, and these changes are only in corporation tax. That's it. Uh, that was all about this. So this is also the end of our smart super, you can say crash course, you can say smart super revision for ATX also. This is the last video of the revision also. So simply thank you very much watching this lecture. Have a nice life. I think I would say within 24 or maybe 25 videos, we have covered Alhamdulillah entire ATX in our revision course. And 25 videos, and where each video was approximately 30 minutes, which means we took around, I would say, 12.5 to 13 hours, or maybe 14, not more than that. So within 13 to 14 hours, Alhamdulillah, we covered all the concepts, all the rules of ATX. So I think this smart crash course, you can say smart revision course of ATX, that's just a blessing for my students, Alhamdulillah. that within a very limited period of time, I think 13 to 14 hours is nothing to brush up all the concepts of ATX. So I think what else do you want? So simply thank you very much watching this lecture. Assalamu alaikum.